Welcome back to Bluesphere TV. Today, we're diving into the 25 different types of investment funds. From ETFs to hedge funds, rates, to ethical investing, there are so many different options it can be confusing to know where to start. So in this video, I'm going to break down the major types of investment funds, organised into 5 easy categories, and explain which ones might be right for you. Let's get started. Category 1, passive funds. Low-cost, long-term investing. 1. ETFs, exchange-traded funds. ETFs are like a basket of stocks or other assets that trade on an exchange. They're low-cost, diversified, and easy to buy or sell. Great for beginners. 2. Index funds. These are passive funds that mirror the performance of an index, like the S&P 500 or FTSE 100. They're known for simplicity, low fees, and long-term returns. 3. Money market funds. These invest in short-term, low-risk securities like treasury bills, cash and cash equivalents. Very low return, but also very low risk. Ideal for parking cash safely. They are typically appropriate for an investor with a time horizon of under 3 years. 4. Target date funds, designed for retirement. You pick a year and the fund automatically adjusts to become more conservative as you approach that date. Ideal for set-it-and-forget-it investors. Vanguard in particular has some very popular target date retirement funds. 5. Smart beta funds. A hybrid between passive and active investing. These are rules to weight stocks differently, like focusing on value, dividends, or momentum, rather than just size. Category 2. Active funds, professionally managed. 6. Mutual funds. These pool money from many investors to invest in a variety of assets, managed by professionals, good for long-term investing, but typically higher in fees than passive options. 7. Managed funds. A broad term for any fund with a professional manager actively making investment decisions. These aim to beat the market, but can potentially underperform after fees. 8. Absolute return funds. The goal here is to generate positive returns in all market conditions. They use a variety of strategies and assets, which may include derivatives, hedging, and alternative assets. Returns can vary and fees may be higher. Make sure to watch out for high fees and complexity. 9. Balanced funds. These invest in a mix of stocks and bonds, offering a blend of growth and income. Perfect if you want moderate risk and less volatility than a pure stock fund. 10. Mixed funds. Similar to balanced funds, but even more diversified. Mixed funds might include stocks, bonds, cash and commodities, and even alternatives in one portfolio. Ideal for investors who want broad exposure in one place. 11. Fund of funds, or FOF. A fund that invests in other funds. This adds an extra layer of diversification, but also higher fees, often used in pensions and institutional investing. Category 3. Alternative and private investment funds. 12. Hedge funds. These are aggressive investment funds that use complex strategies like leverage, derivatives, and short selling. They aim for high returns, but they're high risk, less regulated, and usually limited to wealthy investors. Some of them have minimum entry investments of over $20 million. You usually have to be classed as an accredited or professional investor to access these. 13. Private investment funds. These include private equity and venture capital, which invest in startups or private companies. Potential for high returns, but illiquid and high risk. Usually only for accredited investors. 14. Alternative investment fund managers, or AIFMs. AIFMs manage alternative, non-traditional assets like hedge funds, real estate, infrastructure, and private equity. They are designed for investors seeking diversification beyond stocks and bonds. In the EU, these are regulated under AIFMD to protect investors. 15. Alternative investment funds. A broader category covering crypto, collectibles, art, hedge funds, and real assets. They tend to have low correlation with stock markets, but can be risky and hard to sell. 16. Commodities funds. These invest in raw materials like gold, oil, or agricultural goods. There are funds that will track commodity prices. Used to hedge against inflation or diversity portfolios, prices can be volatile. 17. Fund derivatives. These are financial contracts whose value is tied to a fund's performance, typically used by advanced investors or institutions to hedge or speculate, not for beginners. Category 4. Real asset and property-based funds. 18. Real estate investment trusts, REITs. REITs let you invest in real estate without owning property. They're traded like stocks and often pay regular dividends. Great for passive income and diversification. 19. Investing in property via funds aside from REITs. You can invest in property funds or crowdfunding platforms that give you exposure to commercial or residential property markets. Liquidity can vary. 20. Infrastructure funds. These invest in physical infrastructure like toll roads, airports, or renewable energy projects. Great for long-term, stable cash flow. Category 5. Specialty, thematic, and ethical funds. 21. ESG funds. Environmental, social, governance. These invest in companies that meet specific ethical criteria, like being environmentally friendly or socially responsible. A great choice if you want your investments to align with your values. 22. Thematic funds. These invest in big transformative trends like AI, clean energy, robotic, or blockchain. High risk, high reward, perfect for future-focused investors. 23. Sector funds. These target a specific industry like tech, healthcare, energy, or finance. Good if you have a strong view on a particular sector's growth. 24. Global funds. Investing in companies all over the world, not just your home country. Helps diversify internationally and capture global growth opportunities. 25. Investment trusts. Closed-ended funds traded on stock exchanges. They can be actively managed and are often flexible or may trade at a premium or discount to the value of their assets. A good alternative to traditional mutual funds. Things to consider before you invest. 1. Liquidity. Can you easily buy or sell the fund? ETFs and index funds are liquid. Private equity and hedge funds may lock up your money for years. 2. Risk tolerance. Some funds are low risk, money markets, bonds, while others are high risk, crypto, hedge funds, commodities. Choose based on your risk profile. 3. Fees. Active funds, hedge funds, and funds of funds usually have higher fees. Low-cost ETFs and index funds are ideal for most beginner investors. 4. Tax considerations. Different funds have different tax impacts. Check whether the fund distributes income, how gains are taxed, and whether if it fits in a tax advantage account. And there you have it, 25 types of investment funds broken down into 5 categories so that you can choose what's right for your goals, risk level, and investing style. Remember, you don't have to invest in everything. Start with what makes sense for you, whether that's simple index fund or exploring more advanced strategies down the line. If you found this helpful, make sure to like this video, subscribe to Bluespear TV, and hit the bell so you don't miss future videos on investing and building wealth. Let me know in the comments which type of fund are you most interested in. I'd love to hear from you. Thanks for watching, and I'll see you in the next one.